Welcome to Altus Insights podcast series with Ray and Marlon, hosted by me, Avi. This podcast will cover monthly market updates and construction cost impacts across major markets in Canada.
Hi, welcome to the Altus podcast series with Marlon Bray and myself, Ray Wong. Today we have Omar Eltorai, the Director of Research at Altus Group, with more than a decade of experience in the industry in investment management and financing roles. Omar's focus at Altus is on macro capital and market trends affecting U.S. CRE market. Welcome, Omar.
Thank you. Happy to be here.
Great to have you. Today, we are going to discuss Omar's recent webinar, the U.S. State of the Market, and discuss the differences and similarities with respect to the Canadian market. We'll focus on the capital markets, then dive into the multifamily, housing, industrial, and office sectors. Okay, so let's go with the first question. So, Omar, can you give us a brief overview of how has the capital markets performed in the U.S. in 2022? And what you've seen so far in 2023. So discuss perhaps some of the cap rate direction, assets, and regions.
Absolutely. So I think what we've seen over the last year and 2 months has been some pretty big shifts, especially in terms of narrative. So right now we're in a period where the capital markets are searching for a new narrative. As we were closing out 2022, there was a narrative in the marketplace that was widely accepted around a Fed pivot. However, this has really faded quite a bit, and I think especially in the first 2 months of this year, that has really been knocked out as the markets have really turned more of their attention towards higher expectations for higher rates and higher inflation for longer. The result of this was that there was significant softening in the tail end of last year and higher correlations across asset classes. I recently put a piece out in February just highlighting the correlations of how the assets that are usually used to diversify have been trending together, and how the bond market and equity market have dramatically different views and interpretations of what lays ahead. Now, how all of this relates to commercial real estate, I would categorize 2022 as a year that really started off very strong, and that was based on the momentum that we had seen in the banner year that 2021 was. So this was huge transaction volumes, but then it really started to decline and fizzle out through the end of the year. That was a combination of, and predominantly, rising rates that were chasing and trying to tame an a high inflationary environment. And ultimately, by the end of the year, as I mentioned, the narratives that were a little bit more optimistic started to fade away. So while 2022 mid-year might have been, you could characterize the sentiment as being cautiously optimistic. By the end of the year, I think it was striking much more of a cautious tone. And this is very true for commercial real estate as well. Speaking very broadly across the property types, this caution tone came in the form of, and is still present with concerns around effective rent growth, not necessarily just rent growth, but effective rent growth, expense management, and overall financing concerns.
Well, Mar, I know there was a slowdown, and based on all the factors, it's similar to that we're seeing in the Canadian marketplace. But do you think investors, do you think they're still motivated to buy, or do you think they're waiting for sort of price adjustments?
So I would say I think we're at a point where we're going to start seeing different types of motivations come into the into the market as a whole, and there are certainly more motivated buyers. and they're motivated sellers as well. However, where they agree on that where they believe that price point is, I think that's what's stalling, or it really has been stalling the market, like transactions recently, is because they just can't agree on where they think the right price should be. So they're off, and therefore transactions won't take place. I do think that there are quite a few, that there still is motivation on, I guess, both sides. But the higher, not only just the higher cost of financing, but the pullback of a lot of traditional financing sources has made it difficult to get these deals done. Plus, on top of that, you have with if you look at, and I know this is true pretty much across the world, but if you think about Fed funds rate has passed. So if this is your risk-free rate, has actually passed where cap rates were in the last 12 to 18 months, and that gets really difficult to justify. And so I would say that a repricing is needed, but on top of that repricing, you also need the financing to come back to the market to enable transactions to take place.
So basically, it's getting more expensive for deals to happen, and there's a risk element. And perhaps some of the assets that are selling, there's a little bit of motivation with some of those transactions.
Yes.
Wouldn't there be opportunists in the market though right now? I mean, that's the thing we're seeing just anecdotally is a lot of people are sort of circling around waiting for those opportune deals to grab them while they can.
Absolutely. And if you look at the fundraising, so I know Preqin puts out the numbers, but if you look at by strategy, right, of what real estate fund strategies are actually raising money, it's the opportunistic / distressed category is hands down the only one that is really able to fundraise at the moment. And they started really, you saw that really take off over all of last year. And that money has not been able to, like, just looking at the market as a whole. And this is where you have this breakdown of buyers and sellers of where they think the price should be and the entry point that would justify the overall return, whether that's for the investment or the vehicle, the investment vehicle as a whole. It's still, there's a bit of a spread between their expectations. But to your point, Marlon, yes, I think the opportunistic buyers are present, but they haven't been able to be active yet.
So we just need to wait for the market to drop a little bit more, get a little bit worse, a little more blood in the water, and then they'll be able to smell a deal.
Yes. And I would say that if you look at the how much money is there, it's I don't want to say it's comforting, but it is kind of a backstop to pricing as a whole. Like there will be, if enough opportunistic money is waiting for price drops, and they will be competing as prices drop, that actually should support pricing.
Before we get into those the sub-markets, Omar, is there any sort of regional differences? Because we've seen a lot of, population shift to the Sun Belt. Is there more? Is there some more sort of regions sort of at risk, or there's sort of more opportunities than elsewhere just because of some of the shift we've seen in the last few years?
Yeah, and I do think that it's less on. There are less concerns around people reversing their migration and moving. I guess if they were coming from the Northeast and moving to the Southwest or Southeast. I think there's less concern that they're going to all choose to, go back to the Northeast or go back north. However, I do think where there are certain risks is looking at the supply that is coming, or if you look at supply pipelines, a number of the very hot Sun Belt markets have very robust supply that is lined up to be delivered in the next 12 to 18 months. And pairing that with a broader macro environment that has higher recessionary concerns or recessionary risk could mean that the deals are not necessarily going to perform as they were once penciled.
Okay, so this is a good segue into the multifamily sector. So especially from supply and demand side. So what is your overall take on the multi-res side? And here you can definitely get into some of the regions just based on what you just described with a little bit overbuilding. So can you give us and again, it's still, I think, one of your most sort of most in-demand investment types on the multifamily side.
Yeah, and before I get into the negative or kind of the counter arguments, I would highlight that there is a lot of strength with multifamily, and it really comes from the fact that the U.S. has been undersupplied for housing, as well as if you look back to, you have to look back to the global financial crisis and the housing bubble that formed there. And since then, we really have had over a decade of underbuilding happening in the housing space. And so because we've had this deficit, the ability, or I would say that deficit now actually is it's almost like a strength. Right. So even if there are supply concerns in certain areas, it's actually not at the national level. It very much becomes market specific, because going into the global financial crisis, the U.S. we really did overbuild. But that is not the same this time around. Right. And I know those are dangerous words to say. Right. This time it's different. What I'm really watching for is not necessarily just the top line growth, but how expenses are going to continue to perform. Because if you start seeing expense ratios climbing up, as even if they're able to maintain, like I would say, solid to neutral kind of growth on the rent side, if expenses start climbing and eroding NOI, I actually think that that's a really bigger concern. So,
yeah, and we're sort of seeing the same thing, especially with the older projects, and especially with buildings and owners trying to get down to net zero and the whole ESG. So definitely with the older buildings with capital improvements is going to increase some of the cost standpoint, but what we're sort of seeing is that, again, Marlon, we've seen those 20 to 30% sort of headlines as well. At the same time, though, in Toronto, there's rent control, so that yes, the new leases are coming in at 20 and 30%, but all the renewals are coming in at 2 or 3%. Right. So it's sort of like the hype is 20, 30% based on our low vacancy rates across Canada for multifamily. But there's actually a good percentage of renewals that they're coming in a lot lower than what those banners are showing.
It also depends on how much those buildings are leveraged as well as a portfolio. Yeah. How much leverage have they got, and where are they heading in terms of the new financing world, in terms of the overall leverage they have in a portfolio. If you have no financing, the expenses go up a little bit. It's not the end of the world. How many people have no financing? It's a question, or don't leverage those assets for other investments.
Yeah, two things I would add on multifamily there is the first is right on the comment around the rent control. We in the last 12 months there have been a lot more actions and rent control really has come up in the U.S. But of course it's almost always a local issue. California, we actually just did a piece on a bill that's gone through and is going to put that into play across California. But then also I just read this morning around the like Boston as well. So I think rent control certainly is going to be, maybe not so at the fore if rent growth starts coming down and you're not seeing these huge prints of what year over year growth is. But I do think affordability will be an issue that will continue to drive it, especially if we do enter a recession. That will bring it to the fore again. But then another piece I would flag, especially on the multifamily, and it's very U.S. centric, is the agencies. So Fannie and Freddie, they didn't hit their caps last year. So that meant that they ultimately had more capacity that they could be lending. And similar to other periods of whether it's distress or market disruption, the agencies do tend to play a bigger role, especially in multifamily. And one change is effectively their scope of work has been really in the last, I think it was January of this year, FHA came out and broadened their scope. So they're able to actually play or lend in a much larger area, including smaller properties and less kind of traditional multifamily. So I do think that that's certainly a positive as well for specifically for the U.S. Multifamily space.
Rent control generally achieves one thing: a reduction in supply. It just switches to supply lighting off, and that's all it's ever achieved every time they've done it. So it's quite ridiculous. In the Western world, we're still talking about rent control as a means to solving a problem when it's just increased supply, which you're seeing in the US right now. Increased supply is reducing rents. So just increase more.
It cuts two ways, right? Like the intent is for one thing, but it often kind of backfires. And so, but that being said, it's not even if it's not the most effective, that doesn't mean that, it's not used. Unfortunately, that's like, it's one of the tools that is there.
Unintended consequences, the things the government never thinks about.
That's a theme, Marlon, that we should carry forward.
Well, I think most of the problems in the world are unintended consequences of elected officials, but that could be a whole topic on its own.
Before we leave this area, we talked about the traditional lenders, and in Canada, we've seen a lot more sort of private lenders into the marketplace, and that's causing. We're finding that there's a bit of a shift just because of some of the more stringent requirements the banks and typical traditional lenders have had compared to some of the private players, even though perhaps the cost is a little bit more based on the percentages. But are you seeing that shift? Because that's definitely causing that slowdown in the investment market, not just in multifamily as well.
Yeah, absolutely. Some of my favorite data favorite public data is coming from the Fed, and it's the Senior Loan Officer Opinion Survey with the fun acronym of SLOOS. And this really gives an indication of the expectations and kind of the intentions of these senior loan officers. And one of the questions that does come up is whether or not these bank loan officers are tightening or effectively restricting credit. And in the last survey, I think it was 80% said that they were tightening for commercial real estate. Now, there were minor differences, and they do report it on a net percentage, right? So but you can back into kind of, well, okay, if this is the net percentage, how many were actually saying that they were tightening? It was right around 80%. And then on top of that, if you look at over the last, whether it's 12 months, 9 months, the cost of borrowing has actually gone, like just the interest rate has gone up by like multiples. That together means finding financing, very difficult, very difficult. You're not going to have, and this came up on the last state of the market, where you're not going to have, you don't have multiple lenders competing for your business, right? You're going out to ask multiple lenders and maybe getting one or two to bite. But if you're gonna be a borrower, you ultimately are going to be following their, they pretty much are going to be telling you, look, this is what we're doing. If you don't fit, sorry, maybe come back later. So I do think that is certainly a challenge, but it has also high rates plus a backing out of the traditional lenders has created, especially in the U.S., an opportunity for whether it's private credit funds or kind of these let's just call them non-traditional lenders, or maybe they're traditional, but they don't do it at size because they usually manage, or they're going for more niche credit exposure, whether that's have seen the return of mezz lenders have really come back in a meaningful way, but also just lenders that are more willing to take more risk, but that risk often comes at a price.
And to sort of close off this area on pricing and cap rates, what direction do you think is going to go over next? Based on everything you just said with supply, financing, opportunities, investors in the marketplace. So
two things. One, the Fed, as well as the market's reaction and how the market's really pricing the 10-year. That's the 10-year U.S. Treasury, right? So the reason I first focus on the Fed is if you look historically, and I have looked historically at kind of the relationship between the Fed funds rate and cap rates. And what you can see is usually historically as the Fed funds rate has been hiked up, cap rates can give to a certain point. So the spread can really compress quite a bit, but it ultimately you can't keep compressing a spread. And there becomes an illogical point, or where a point when the spread does need to give, when effectively risk-free money should not be worth, risk-free money should not earn you a bigger return than money at risk. And so that is, I'm certainly watching that, but then also the 10-year Treasury is another area, just because it's practically it is the most used for benchmarking pricing, especially in real estate. And so with that, I would say, and I've never been in the camp of fight the Fed. I do think that the Fed is very much they've added this kind of forward expectations and their commentary as one of their tools to help guide the market and set their expectations. And I don't think that they're speaking necessarily in code. They've made it very clear that they are concerned about longer lasting, or stickier inflation, and a lot of that is being contributed by a incredibly tight labor market that has concerns over a wage price spiral, and which is fueling the inflation, right? And so because they haven't necessarily broken that yet and tamed it, expectations really are for them to keep hiking. And I think that this is a long answer to your question. I could have probably just answered it up.
Yes.
but yeah, hopefully you're following with the logic of all of this goes to the point of, what? I do think cap rates are going to continue to go up, and not just from a theoretical standpoint, but I do think that another factor that's going to bring that on is if you do look across banks, and whether it's in their at least in the U.S., whether it's in their filings and their call reports and their call report data, or if it's with the publicly traded banks, that it's great to get some of their commentary on it, but they're building up their loan loss reserves, which means that they're anticipating credit issues, right? They're anticipating writing down and charging off some of their credit exposure in their loan book. And because of that, I think that is a sign that there will be some distress. And that, like, lenders are in the business of lending. It's not in owning real estate. And this is not a call for any sort of bubble, but if you take these kind of high level, the comments of markets have slowed down because cost of financing has gone up and a perceived level of uncertainty has been elevated. We're still in that environment, but there's now a concern around some credit that's out there. And if the lenders do get the keys, they're likely going to be looking for sales. And if there likely will be discounted prices. And if those are discounted prices, that is also, those observations are going to lead to and support higher cap rates.
That's all the time we have for today. And thanks, Omar, for your insightful comments. And it's interesting to see the contrast between some of the trends, some of the similarities, as well as some of the differences in US and Canada. But I guess what we have to do is continue on with sort of another segment, again, with Omar to cover the office and the industrial sector, a bit of a review of 2022 and what we expect for 2023. So please stay tuned for the next sort of continuation of this discussion of the similarities and differences between the US and Canadian markets. Thanks.
Thanks, Omar.
Thank you.